What's going on, guys? Today we're taking a look at closed-end funds to find the best funds for high yields and capital appreciation. If you're new to closed-end funds, I just did a video last week about what makes these investments unique and explained how they are able to generate higher returns and higher dividend payouts than other investment options. So definitely check that out for an intro to closed-end funds. But if you already know what you're getting into, then let's press on and explore the market, because at the end of this video, I will show you the exact closed-end funds I found for a 9 to 10% yield. Stay tuned. For this video, similar to the Dividend ETF video I did a few weeks back, I'm going to walk you through the screening metrics I use to find the best closed-end fund investments. The screening tool I will be using is at cefconnect.com, which I'll link in the description of this video. I'll share why I'm choosing each of these screening metrics so that if you don't agree with my picks, you can go back and tweak some of the things to find the closed-end funds that are best suited for you. After narrowing down our options, I'll leave you with the 2 closed-end funds that I have ultimately approved for my own investments. So let's get right into it with my first screening metric, which will be the fund investment strategy. Closed-end funds might specialize in a number of different things, like municipal bonds or MLPs. I'm definitely not in the market for municipal bonds, and I don't want my closed-end fund to be concentrated in a single sector or industry. So I'm going to eliminate categories that include any of these focused strategies. Next, we're going to set our desired distribution rate. Now, I found some great dividend ETFs in my previous video that were yielding about 5.5%. These ETFs were also simple and passively managed, which eliminates a lot of the headaches of closed-end funds and the risks and costs of active management. From my perspective, I'm taking on more risk by investing in closed-end funds, so I want the yield to be worth it. And since we're here for yield, I'm going to set our minimum distribution rate to 7% annually. And just to clarify, this distribution rate is going to be measured by price, not NAV. I'll be buying these shares at market price, so I think it's more reasonable to use the yield on price instead of the yield on NAV, which will not accurately represent my expected distribution earnings. Our next screening metric is going to be the discount or premium on share prices. As I mentioned in my closed-end fund video last week, one of the largest benefits of closed-end funds is being able to get the underlying assets at a discount. I don't see any good reason to pay a premium, so I'm going to screen out anything that isn't currently trading at a discount. Next, we're going to filter the results by annualized returns. My biggest fear with a closed-end fund is that the people managing it aren't investing in assets that are appreciating. I love dividends as much as the next guy, but if the underlying assets aren't increasing in value, I don't want anything to do with it, especially when you consider that a fund will straight up run out of money if they aren't generating enough profits to sustain distributions and maintain the current net asset value. I'm willing to be a little forgiving with the short-term price history, especially because the COVID pandemic did so much damage to the markets, so we will ignore any 1-year or year-to-date returns. With 3-year returns, I'll stay a little flexible and look for anything with positive annualized returns. But we're going to be a little stricter with 5-year annualized returns, for which I want to see annualized returns greater than 7%. I'm using NAV here and not price because the NAV will more accurately reflect the performance of the portfolio and the management team, while the price will be more influenced by market activity. The last screening metric I want to discuss is the type of distribution strategy a fund is using. We can choose between a managed distribution rate and an income-only distribution rate. With a managed distribution, funds will typically target a certain distribution percentage based on the expected long-term performance of the fund, paying you with both dividends and realized capital gains. But in the event that the fund doesn't make enough money to pay those distributions, they'll supplement it with a return of capital. This creates a complicated tax situation and one that I'm not particularly interested in. However, I believe there might be some funds out there that are following a managed distribution strategy, but that are also successful enough that they don't need to rely on a return of capital. So I'm going to look at both income-only and managed distribution funds, and start by ruling out the closed-end funds that look heavy on return of capital. So with all of these screening metrics in place, we've narrowed down from nearly 500 closed-end funds to just 28 fund options. 10 of these are income-only strategies and 18 are managed distribution strategies. So before going any further, I went through all of the managed distribution options to make sure they were actually generating enough profits and not using a return of capital to fund distributions. I found that 12 of these options were funding their distributions almost entirely with a return of capital. That's a lot of these funds, so I'm glad I took a closer look, and this is exactly why you shouldn't just jump into an investment after seeing a high yield. But now we're left with 16 closed-end fund options. So next I'm going to take a closer look at the rest of the distributions for 2 things. First, I want to see that these distributions are either stable or increasing over time. I'm also going to look at the taxation of the distributions, because some will be taxed as income and some will be taxed at the capital gains rate. So for optimal long-term returns, I want growing or stable distributions and the favorable capital gains tax rate on those distributions. However, I am willing to take a closer look at funds that are taxed at the income tax rate if the distributions are a little bit higher and appear safe. With this in mind, I was able to easily rule out 7 of the remaining options, leaving just 9 closed-end funds. At this point, I'm going to take a quick look at the price history since the inception of each of these remaining funds. I'll put all 9 of these on the screen so you guys can see what I'm looking at. I quickly ruled out RVT, ETO, and CGO because their performance doesn't look like the management has been particularly successful over time. I'm also going to rule out ETG because its performance is pretty lackluster and it's also paying distributions taxed as income. Next, I'm going to rule out CSQ. Its price history looks pretty good, but it's trading at a very slight discount with huge fees of over 3%, lots of leverage, and distributions being mostly made up of a return of capital. This leaves us with just 4 closed-end funds. So now we're going to get into some of the deeper analysis with ACV, USA, JTD, and EVT. We already know that these remaining funds meet my criteria for closed-end funds, so they should all generally be decent candidates. That said, I'm going to have to get picky with these choices because I want to make sure I invest in the fund that I feel the absolute strongest about. The first one we're going to look at is ACV, the AllianzGI Diversified Income and Convertible Fund. It's actually the only remaining fund that is using an income-only distribution strategy. It's only been around since 2015, but we can see that they've been absolutely consistent with their dividend distributions, and they're entirely taxed at the long-term capital gains tax rate. I love this, and it's also great to see that the NAV is generally trending upwards. However, my first concern is that with this income distribution strategy, I would expect the distributions to increase as the fund generates more income. Even though the NAV has increased over time, the distributions have remained the same. So I pulled up the annual report and took a closer look at the net investment income of this fund over the last few years. Theoretically, you want to see the investment income grow because it shows that they're investing in assets that are producing an increasing amount of income. But the net investment income has actually been decreasing for 4 years. Most of the profits they're earning and paying to investors are from selling assets. My concern here is that they aren't generating a whole lot of profit, so they're going to have to regularly churn through their portfolio, selling assets to fund distributions. And this is clearly what's happening because their portfolio turnover rate is absurdly high. If that's not enough to convince you, this fund also has really high expenses of 3.3%. It is trading at a historically attractive discount, but that's not going to be enough for me, so I'm going to rule ACV out. Next, we're going to take a look at USA, the Liberty All-Star Equity Fund. This thing has an impressive yield of 10.4% and a lot of other attractive qualities as well. It has expenses just under 1%, and it doesn't use any leverage whatsoever, which is really rare for closed-end funds. So it's awesome that they're able to produce these distributions, continue growing their capital, and keep costs low for investors, all without the added risk of debt. Their distributions have grown consistently over the last 10 years, and they've mostly been made up of long-term capital gains, with a very small 3% being made up of a return of capital. Although according to their annual report, the return of capital has been a little higher in previous years, so that's something to keep an eye on. What I think is really cool about this fund is that its assets are split equally 5 ways among 5 different fund managers. 60% of the assets are divided among 3 management teams with a value investing approach, and the other 40% is split among 2 management teams with a growth investing approach. I really like this because it just adds another layer of diversification to the fund, because each of these managers are acting independently of one another. This greatly reduces the risk that one management team will do something that will sabotage the entire portfolio. So I think this is a pretty good sign for the long-term stability of the fund. The one thing that is puzzling to me is the price performance since inception. The USA fund was created in 1986, and the fund's NAV and price have fallen significantly since then. So this does not create an attractive long-term annualized return from the fund. But for the last 10 years, the fund has actually performed quite well. It's not uncommon for funds to change management if they're unsuccessful, so I'm wondering if this is what happened at some point in the fund's history. I couldn't find anything on this, so I can't say for sure, but I'm hoping that's the case because I would feel much better knowing that the people responsible for that long-term decline are no longer involved in the fund. So there are a lot of things I like about this fund, from the high distribution rate to the unique division of assets among different fund managers. Right now, the only thing stopping me from investing is the fact that shares are currently trading at a discount of about 8%. I'm guessing there are some income investors out there who have recently discovered the value of this fund, because the fund has historically traded at around a 10 to 15% discount for the last 10 years. So personally, this is not something I'm ready to jump into super aggressively just yet, but when I see the fund slip into a discount range greater than 10%, I will probably be taking advantage of that opportunity. Next, we're taking a look at JTD, the Nuveen Tax Advantaged Dividend Growth Fund. They've got a pretty nice yield at about 9%. Looking at their annual report, their investment income has been decreasing slightly over the last few years. Recently, their distributions have been about 1/3 taxable as income and 2/3 taxable at the capital gains rate, which isn't too bad. The fund is pretty highly leveraged at around 30%, which is going to bring more risk and more costs to investors. This brings the total expenses to about 2.7%, which is definitely on the higher end for the category. You can see that their borrowing has not been particularly good for investors because the fees have increased over the past few years, which we wouldn't want to see continue. Ultimately, this seems like a pretty expensive fund to hold, and I'd be worried it's going to grow more expensive over time. Furthermore, I'd be a little concerned for them to begin issuing returns of capital like they've done in the past. With these things in mind, I think I would rule out this fund for a long-term investment, at least with how things are currently trending. On the bright side, shares are currently trading at about a 14% discount, which is the largest discount we've seen since the financial crisis of 2008. For that reason, this might be a good short-term opportunity, but this might also be an effect of investors catching on to the increase in leverage lately, so it's not something I would personally be taking a chance on. And last, we're looking at EVT, the Eaton Vance Tax Advantage Dividend Income Fund. It's currently yielding about 8.75% on price, which, just like JTD, is approximately 1/3 income and 2/3 capital gains. And it's trading around a 10% discount, which is just about the lowest it's been in approximately 5 years. In the annual report, I found that interest expenses, currently at 1.95%, have been increasing over time, and portfolio turnover is also pretty high, neither of which I like. So considering that the NAV has not been moving a whole lot in the last few years, and I'm still not great at picking apart these reports, I can't say I feel particularly confident in the future growth potential of the fund. That said, I did find that 17% of the fund's total makeup is represented by the financial industry. This is a pretty sizable portion of the fund, which isn't ideal right now because banks have been hit pretty hard by the pandemic. But I also think this fund could represent a great value investing opportunity for when banks eventually recover from the pandemic, and you can enjoy a nearly 9% yield in the meantime. Overall, I think EVT is a good candidate and probably a safer pick than JTD. It's just hard to tell how long the portfolio's weight and financials will hold it back, if at all. I'd be hesitant to commit to this long term, but since it's historically traded at around $22, which tracked the NAV pretty closely, I think this could be a good value investing opportunity. After looking at all of these funds, I think USA and EVT are the best options among the closed-end funds I found. I'd be much more excited about USA if it were trading at a bigger discount, so this is something I'll be keeping an eye on before getting too invested. But I love that it has a 10% yield and expenses under 1%. And I appreciate the unique way they split the fund's assets between the fund managers. EVT is also a pretty exciting option with a 9% yield, although expenses are a little higher than I'd like at around 2%. I would like to see the leverage and portfolio turnover to be a little lower, but this is something I might invest in for the short term because I think it might be currently undervalued with an unusual discount of about 10%. So what do you guys think? Are you investing in closed-end funds that I didn't cover? If so, please share them in the comments because I'd love to keep exploring the options out there, and I'd really enjoy hearing someone else's take on these funds. There's so much to read up on when it comes to these investments, and I'm sure I'll be researching them a lot more in the future. So if you want to see more videos about this stuff, make sure you subscribe to the channel, and I will see you in the next video.